We have a crisis, and clearly we thought we may have part solution yesterday. That did not happen. Dan, first my question to you, how did we get here? What brought us to this situation here? Would you give us some perspective?
Last week Sridhar came to me and he said, Dan, this is the question I want you to answer. How do we get here? And you have 5 minutes to answer it. So that's quite a task. Obviously what I'll be giving to you is going to be very abbreviated and quite terse. But I thought I'd start by just reading a simple statement by University of California economist Brad Long. He also was asked the same question, how do we get here? And this was his response. Well, because the investors and creditors did not do their due diligence and check that the banks that were the ultimate holders of derivative securities had done their due diligence, and check the financiers who had created the derivatives had done their due diligence, and check the purchasers of securities had done their due diligence, and check the securitizers had done their due diligence, and check the lenders had done their due diligence, and check that the home buyers had done their due diligence, and check that they could afford their mortgages if houses prices stopped going up. Catastrophic failures of risk management at 7 different points along the chain, any one of which would have kept us out of this current mess. Okay, so there's a lot of blame to go around. If a lot of people want to point finger and say, well, it's these people's fault, or it was greed in this particular area, it was the home buyers, it was the mortgage originators, there's a lot of places where things didn't work as well as we think they might work in a market economy. What I'd like to do with how did we get here is I'd like to separate it into 3 separate components, just sort of 3 broad things. And the first thing I'd like to talk about is what happened in the early part of this decade. There was just a glut of global liquidity, sort of the opposite of what we're seeing today. I can illustrate this by a quick graph showing the federal funds rate. We can see that after the terrorist attacks and after the recession in 2001, that the Fed greatly reduced interest rates, lowered them in 2003, 2004, to 1%. Now these are the lowest federal funds rate, which is the rate at which banks can basically borrow and lend to other banks. That's the lowest rate in 40 years. So what we had is we had a huge amount of money coming in from the Fed. We also had a huge amount of money just basically floating around the world that was looking for a place to go. People were sort of shy about putting money into the stock markets. Where do they go? Real estate seemed like a good place for it to go. So a lot of money got put into the real estate market. Paul Isley later on, I believe, will talk about how this affected housing prices. But basically that's what started. We had a lot of money that could go into the housing markets. Housing prices started to rise. With all this money there, we kept looking for more and more ways to utilize it. Can we give more mortgages to more people? People who we might not have given a mortgage to before? Can we find a way to use this money so that they can also purchase a home? So that's one of the main things. There was a lot of money out there, and it made it available to a lot of people who wouldn't have otherwise had an opportunity to have it. A second thing that a lot of people are considering as being an important factor in what's happened here is in the housing market bubble and then subsequent decline, that we might have misaligned incentives in the originate to distribute lending model. So if we think back to the old days, you went to the bank to get a mortgage, and they would inspect you. They would see if you were worthy of getting the mortgage or not, and they wanted you to pay back the mortgage. And the reason they wanted you to pay back the mortgage is because they were the people who are getting repaid. So you don't want to make a loan to somebody if you think they're not going to be able to repay it. Okay, you don't want to have to foreclose on them. That's not something that you want to do. So you're going to inspect very carefully who you're making a loan to. As we started to move more into the idea that people would originate the mortgages and then sell them off, either securitize them or just sell them off to other people, we get into what's economists call principal agent problem. Okay, what you have is you have the people who are helping to originate the loans, who are investigating the people, supposedly investigating the people who are willing to buy the house to make sure that they can afford it. Well, their incentives aren't quite as strong anymore. Okay, if I originate the loan and the person takes it out, once I get my fee and I pass that mortgage on to someone else, I'm sort of out of the loop. I don't necessarily have to care if the people repay the mortgage or not. And so this could be a problem. Now it's not quite that clear. I mean, there still are potentially some incentives that might make people want to not give out bad loans, but there certainly is this principal agent problem where the people who are not underwriting the loans, the people who are originating the loans might not be doing what's in the best interest of the people who are actually providing the funds. Now, this does lead to a problem. If we think that's the overall story, well, then we have to think about, well, what were the people providing the funds to these mortgage originators? Why were they being irrational? Okay, why didn't they realize that they could be tricked so easily? So that's one of the problems with this originate to distribute lending model, although this certainly is something that's getting a lot of play right now. So this is another factor that we want to keep in mind. A third thing that's probably really important right now in the whole mess is what we can consider information problems in the market for these mortgage-backed and other related assets. When the mortgages were taken out and maybe they were originated but then sold to somebody else, what happened with these mortgages is they weren't held individually. They were split up. And I can actually give a picture of this. This comes from a paper that just came out earlier this month, a National Bureau of Economic Research working paper by Gary Gorton. And he has this actually, it's a relatively simple picture. And I'll title it here, Information Problems in Asset Markets, but let me paraphrase it. What one of my students said last week when I talked about this. It was, that's sort of a paraphrasing. So this joke was a lot funnier yesterday morning. It's not quite as funny now. But what we can see happening is that subprime mortgages were taken out, and then they were split into mortgage bonds. And then what happened with the bonds is the bonds it almost worked like a waterfall, a cascade. So the bonds that were rated AAA would get paid first, and then after they got paid off, the ones that were AA would get paid off, and then the single A would get paid off. And then what people decided to do is we don't have to just hold them there. What we can do is we can actually separate these bonds into what are called collateralized debt obligations. And then those got split up as well, so it was like a second series of cascades. And one of the interesting things that we see is if you see the triple B mortgage bonds could get turned into AAA collateralized debt obligations. And that's sort of interesting, and then you can see it could go on from there. So, and with these collateralized debt obligations, the way the picture has it here makes it look like it's just derived from one single bond. But actually what happens when they would put these packages together, they might bring in 100 or so different bonds that would fit into it. So if you're buying one of these CDOs, it's hard to tell what it's really worth because you have to know what is the bonds, the mortgage bonds going to pay off. And there might be 100 different mortgage bonds, and each one of these mortgage bonds might be based upon, say, 1,000 different individual mortgages. So you have to find out what's going on there. And then it gets even a little bit more complicated because you could buy insurance on these. You could buy what is called credit default swaps. So if your CDO doesn't pay off, well, then you go to the insurer. Maybe it's AIG, for example, or some other bank, and they will make you whole. You could also then trade. If you bought insurance, you could trade the insurance. The people who issued the insurance, they could trade the insurance. And so we have all these assets that are based upon mortgages. And in a perfect world, you would be able to sit down and just calculate. You just run some sort of probability distribution, and you spit out the answer to what the prices of these things should be worth, what their market value should be worth. Unfortunately, it seems like it's difficult to do that. As a matter of fact, maybe even virtually impossible to do it. So that's sort of the underlying thing. I think Michael might talk about this a little bit more in more detail. He might not, but that just gives you a feeling for what happens is there's all these assets out there, and really nobody knows what they're worth. And so when they go to trade them now, people might not buy them because are they good or are they bad? And it's not even a case of asymmetric information. Asymmetric information is where the person who is selling the asset knows if it's good, and you, the potential buyer, don't know it's good. In this case, we have asymmetric information, but it's because both parties don't know what they're worth. And so nobody really wants to buy.
30 seconds.
So let me go through quickly. I have 30 seconds left. Some key early events in the crisis. Larry Bloss is going to pick up later, but in 2007, HSBC was sort of the first indication there might be something going on. They wrote down more than $10 billion in assets that were basically based on subprime U.S. mortgages. August 9, 2007 is probably going to be, when people go back and look at when did this crisis start, they're probably going to pick this date. And this is when a large French bank, BNP Paribas, froze 3 of their investment funds. And they basically said right now it's impossible to value certain assets. That's what they said. And this is a very sophisticated bank, and they said we can't value them. We're gonna freeze withdrawals. Last September we had Northern Rock, a British bank which experienced bank runs. This was the first bank run, Mary Poppins notwithstanding, in England in 150 years. Okay, this is not something they experienced, and all of a sudden Northern Rock experienced in bank runs. It was eventually nationalized. It's a big problem. I picked the Bear Stearns takeover by J.P. Morgan as something that happened in the United States. It's sort of a signal to the broader business community that, hey, this is a big problem. And then I also picked July 11th of this year with the Indy Mac failure that maybe signaled to the overall public that, wait a minute, now we have actual real banks failing. Now we have to start worrying about our deposits. Will they be safe? And so that's basically sort of how we got to where we are now.